All right, class, welcome. Today we're going to talk about a decision that, believe me, every single business faces sooner or later: what to do with old equipment. Now, on the surface, it sounds incredibly simple, right? You sell it, you get some cash, you move on. But how you account for that one transaction, well, that can tell you a surprising amount about your business. Today, we're going to peel back the layers of this seemingly simple event. We're going to move beyond just the bookkeeping and see how these numbers actually inform critical business strategy.
So let's start with this core question. Your business sells an old asset. Is it really just a simple cash transaction? I mean, on the surface, of course it is. Cash comes in, the asset goes out. But if we want to understand the real financial impact, and as future business leaders, you have to, we've got to dig much, much deeper. The way we account for this single event reveals the difference between just being a number cruncher and actually using financial information to make smart decisions. And that's the journey we're on today.
You know, theory is great, but to really wrap our heads around this, we need to see it in action. So let's invent a small company that's facing this exact problem. We're going to call them Pixel Push Graphics. And as you can see, they're at a bit of a crossroads. By following their story, we can see exactly how these accounting principles play out in the real world, with real money and real consequences. So this is Pixel Push Graphics. Imagine, 5 years ago, they invested $10,000 in a server that was absolutely top of the line. It was the engine of their entire business. But we all know how fast technology moves. Fast forward to today, and that server is a bottleneck. It's slowing them down, costing them time, and maybe even clients. Now, the business decision is a no-brainer. They have to upgrade to stay competitive. But that simple business decision triggers a really crucial accounting decision. What do we do with this old server that's still sitting on our books? That's what we're here to figure out.
Okay, so their first instinct, and maybe yours too, might be to ask, hey, what can we get for this old thing on Craigslist? But in the world of accounting, that's actually not the first question we ask. The first question is an internal one. What is this server worth on our company's financial statements right now? This is what we call the book value puzzle, and solving it is the absolute mandatory first step in this whole process.
And here is the single most important idea to grasp right at the beginning. That server is not a $10,000 asset on their books anymore. Just think about it logically. For 5 years, it's been humming along, helping them create designs, serve clients, and generate revenue. It has been used up a little bit each year, and we need a systematic way to account for that usage. This gets to a core idea of accrual accounting that we call the matching principle. We want to match the expense of using an asset to the revenues it helps generate over the same period of time. And the mechanism we use for that? It's depreciation. It has nothing to do with what the server is worth on the open market. It's simply the accounting process of allocating that original $10,000 cost over its useful life.
Let's put a pin in this definition right here, because it is absolutely critical for you to understand. Book value is not market value. Let me say that one more time. Book value is not what someone on eBay will pay you for it. Think of book value as the asset's story as told by the company's accounting records. It's a purely internal historical number. We take that original price tag, the historical cost, and we subtract all the depreciation we've recorded over the years. That running total of depreciation is tracked in a very special account called accumulated depreciation. Now, this is what we call a contra asset account. That means it lives on the balance sheet right next to the assets, but it has an opposite, credit balance, which reduces the total value of the asset.
And this table here lays out the calculation perfectly for us. You see at the top, the original cost, $10,000. That number never, ever changes as long as we own the asset. Then we subtract the 5 years of accumulated depreciation, which, for Pixel Push, comes to $8,000. Simple subtraction leaves us with a net book value of $2,000. This number, this $2,000, is our starting line. It's the anchor, the benchmark against which we're going to measure the outcome of the sale. All right, now for the moment of truth. Pixel Push has been marketing the old server, they found a buyer, and they finally settled on a price. We now have the two numbers we need to solve this whole puzzle: the cash they're going to get from the sale and that $2,000 book value we just calculated.
You know, the concept really is as simple as the scale you see on this slide. If the cash you receive is more than the asset's book value, you have a gain. If the book value is more than the cash you receive, you have a loss. It's that straightforward. And listen, this isn't just some paper exercise. This gain or loss flows directly to the other revenues and expenses section of the income statement. It directly impacts the company's reported net income for the year. It really is the final chapter in this asset story on our books.
So let's play this out with two different, very realistic scenarios. In scenario A, let's say the manager at Pixel Push is a pretty solid negotiator.
They find a local design student who is just thrilled to get a professional-grade server, even an older one, and happily agrees to pay $2,500 in cold hard cash.
And here's the math. Pretty simple, right? They got $2,500 in cash for an asset that was on their books with a value of $2,000. That difference is a $500 gain on disposal. This gain is treated just like revenue on the income statement. It's a positive event that will directly increase their net income for the period.
Okay, now let's look at a different, less rosy but equally possible outcome. In scenario B, the market for 5-year-old servers is just flooded. After weeks of trying to sell it, the absolute best offer they can get is just $1,200 cash. Now think about this. The server is the same, its history with the company is the same, and its book value is still that same $2,000. The only thing that's changed is the external market reality.
So in this scenario, the math just flips on its head. They received $1,200 for an asset that had a book value of $2,000. This results in an $800 loss on disposal. And this loss? It hits the income statement just like an expense, which means it's going to reduce their overall profit for the period.
Okay, so we get the concept. We understand the gain, we understand the loss. Now, we have to do the work. We have to actually speak the language of accounting, and that means making a proper journal entry. This is the technical part, I know, but getting it exactly right is essential to make sure the company's financial statements stay accurate and balanced.
I want you to think of this journal entry as a 4-step recipe, and we have to follow it precisely every single time. Let's walk through the logic. Step 1. Cash in. We got cash. Cash is an asset. To make an asset account go up, we always debit it. Easy. Step 2. AD out. This is the step everyone forgets. Accumulated depreciation is a contra asset, which has a normal credit balance. To make it go away, to zero it out, we have to do the opposite, so we debit it. Step 3. Asset out. We are getting rid of the server. The equipment account is an asset, which has a normal debit balance. To remove it from our books, we must credit it for its full original cost. And step 4, the plug. Finally, we record our gain or loss. A gain acts like revenue, so it gets a credit. A loss acts like an expense, so it gets a debit. This last step is what makes the whole thing balance out perfectly.
So let's apply that recipe to our gain scenario. Scenario A. Look at the debit column. We debit cash for $2,500 because our cash balance went up. Then, we debit accumulated depreciation for the full $8,000 to wipe its entire history off our books. Now, add those two debits together. $2,500 plus $8,000 gives us total debits of $10,500. Okay, now look at the credit column. We credit the equipment account for its original cost of $10,000 to completely remove it, and we credit the gain on disposal for the $500 we calculated. So what are our total credits? $10,000 plus $500 is $10,500. Our debits equal our credits. The entry is in balance. We have perfectly recorded the entire story of this transaction.
Now, I need you to pay close attention here, because this slide highlights the two most common mistakes I see students make year after year, and they both completely break the logic of the accounting system. First, students forget to debit accumulated depreciation. You can't just remove the asset. You have to remove its little partner account too. If you don't, you'll have this ghost account on your balance sheet forever, a contra asset that's tied to an asset that doesn't even exist anymore. The second big mistake is trying to credit the equipment account for its book value, in this case $2,000. That is wrong. You absolutely must credit it for the original historical cost, $10,000. Why? Because the accounting system needs to see both the original cost and the full accumulated depreciation disappear at the same time. You are completely erasing all historical traces of that asset from your balance sheet.
Okay, we've got the mechanics down. We can calculate the gain or loss, we can do the journal entry, but now we need to take off our bookkeeper hat and put on our manager hat, our analyst hat. This isn't just about getting the numbers right. It's about understanding what these numbers mean. What does recording a gain or a loss actually tell a business leader about their company? This, right here, is where accounting becomes a powerful tool for strategy.
The textbook definition you see here is technically perfect. It's 100% correct. A gain or loss happens when the selling price is different from the book value. But an effective manager, a real decision maker, cannot stop there. A manager has to ask the next, more important question. Why? Why was our internal historical accounting number different from the external current market price? The answer to that question, that's where the real insight is hiding.
And here it is. This is the single most important takeaway from our entire discussion today. That $500 gain probably doesn't mean the manager was a rockstar negotiator. What it really tells us is that our original accounting estimate for depreciation was probably wrong from the start.
In this case, we were depreciating the asset too fast. Our book value of $2,000 was artificially low compared to what the market thought it was actually worth. A gain is simply feedback that your depreciation expense in prior years was too high. And conversely, a loss is feedback that you were depreciating too slowly. A gain and loss on disposal is essentially a report card on your past accounting assumptions.
So I'll leave you with this final question to think about. An accounting gain or loss is always backward-looking. It's the final chapter of an old story, a commentary on a past decision and a past estimate. But the real strategic decision, selling the old to invest in the new, that is always, always forward-looking. The goal isn't to get a $500 accounting gain. The goal is to make a smart investment in a new server that's going to generate thousands and thousands of dollars in future profits. As a future business leader, you have to remember that. Never confuse a good accounting outcome with a good strategic move. Your job isn't just to read the numbers, it's to use them to build a better future for your business.